Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss how to love and ride investment bubbles.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research in Quantpedia. Today we will discuss how to approach investment bubbles. What should we do when we see the bubble in the market? Should we ride it? Should we short it? Should we stay away? Now that's a really good question, and we will help ourselves with academic research. But firstly, let's discuss and define what is the bubble and how does the bubble look like. So here we have the main stages in a bubble. I mean, this is the chart I would say nearly everybody knows. We have a still phase when there is a takeoff of a bubble, so the smart money are investing, nobody other knows about the investment. Then we have institutional investors, so they are still smart money and they start to understand, that there is some interesting innovation or there is some interesting investment, and they start to invest. What does it happen is that the price goes up over the average mean or something like that. So investment is already a little expensive, but the retail is still not investing into that idea. Then we have a mania phase. So that's the phase when the public starts to invest. So we have a lot of media attention, enthusiasm, and there is a greed between the public. And at the end, there are articles about the new paradigm shift, about the new tech, or anything that will change the world, etc., etc. So that's the mania phase. I mean, the price really take off, it goes to the moon, and everybody is buying. I mean, even your mom, even everybody, even your plumber, anybody. So everybody is buying, and what does it happen after the end? So there is a trap, there is a return to normal, fear, capitulation, blow off the face. I mean, the price will get back and return to mean. Most of the people that bought during the phase of the mania phase, they lost the money. Usually the smart money institutional investors, they sell to the retail during this time blow up phase. This is how the usual bubble look like. I mean, there are a lot of bubbles in the history. This is the chart from 2021. You probably know how does it look like with the red line. So in the 70s we had the bubble in the gold, then 80s, 90s we had the bubble in the Japanese equities, then in emerging market, then there was a bubble in tech stocks, US housing, then it was a small bubble in China, and after 2009 it was in the biotech, and from 2009 until 2021 or 2022 there was a big bubble in the disruptors. So there were all of the tech stocks, growth stocks, Bitcoin, cryptos, and stuff like that. And right now it's 2023. I would say all of you know how it ended up, what were the drawdowns in all of those tech stocks and all of those great companies that looked really great on the paper, 2 or 3 years ago. But the question is, what should we do with the bubbles? Should we ride them? Should we short them? Should we stay away? There is a great paper written by Maben Faber from Cambria Investment Management. It was written in 2011, but it's really great because, I mean, it gives you a quick idea of what to do with the bubble. So the question is, what if Sir Isaac Newton had been a trend follower, and how to learn to love investment bubbles? So you may not know, but the bubbles are not something special that, pop up in 20th century or in 21st century. We had a lot of bubbles in previous centuries. One of the biggest bubbles was South Sea stock bubble from December 1718 until December 1721, so it was in 18th century. And the great physics Isaac Newton tried to get rich during that bubble. Yeah, he was the public, so he invested a bit, then he was exited happy. He saw all of the other friends get rich, so Newton enters with a lot of the money, nearly at the top of the bubble, and then he exits broke and he lost significant amount of money. So he was a really unfortunate speculator in South Sea company. So the South Sea bubble was a bubble on an exchange market in England. Now the question is what he should do better at the time. So what was the better idea to do? That's a good question. So he should ride the bubble and then exit with the trend following rule. So once again, in the paper there is a figure with a lot of market bubbles in stocks, currencies, commodities, etc. And there is a very easy idea. So we can use the 10-month simple moving average. We can examine the returns of the investment asset, and compare it to the 10-month simple moving average. If we are over the 10-month simple moving average, we are still in a phase. So we are still in this mania phase. So the price is still going up. Once the price crosses the 10-month moving average and goes under 10-month moving average, we are in a blow-off phase, so we exit the investment. Here is the example how does it work like with S&P 500, how we time with that very simple moving average. And here is how it would look like if we try to do that during the South Sea stock bubble. So if a Newton was a trend follower, he would ride the bubble from the beginning, and yeah, you are not able to exit right at the top because nobody knows where is the top of the bubble, but you will definitely exit the South Sea stock before the really bad drawdown that was, I don't know, 99% or something like that. That's how you can use the simple moving average and market timing model. So I really recommend to check. The research paper is very short, it has only 11 pages, learning to allow the investment bubble. What if Sir Isaac Newton had been a trend follower from Ben Faber. And there is another idea. So we have a strategy in our database called industry momentum. So how to ride industry bubbles. It's based on another paper because we are looking on individual industries, so not just on the whole market. Once again, there is a question: what is the best strategy when investor detects the bubble? So once we detect the bubble, should we step outside? Should we short it? Should we ride it? And academic research shows that it's best to ride. So because the excess returns which investors gain during the riding bubble are more than enough, and they offset the risk during the subsequent crash. So there is always a crash, but we can gain a lot during the bubble. So it makes really sense to ride it. But just we need to know when to exit. What is the trading strategy suggested in the paper? So investment universe consists of equity industry funds or ETFs or anything. So we have a lot of industry ETFs. We use these as a proxy for industry indexes. And then we use the 10 years of past data to calculate the industry alpha based on the CAPM model from the regression. So we calculate what is the industry alpha. The bubble in an industry is detected if the industry alpha is statistically significant. So it means when the alpha in the industry is really high, is statistically significant, then we know that the industry starts to take off. So it means that it really starts to outperform. We should be long in each industry that is experiencing the bubble, and we should apply 1/n rule. So it means the investment universe is divided, or our investment portfolio is divided between all of the industries that are in a bubble. And once there is no bubble, so it means the alpha starts to be not statistically significant, then we get out of the industry, so we make no investment. All of the data examination, calculation, portfolio rebalancing is done on a monthly basis. And how the strategy look like? So this is a strategy from 2008, or backtest from 2008. We have the data from that time. As we can see, or once the calculation shows that there is an industry in a bubble, we buy that industry and we hold in the portfolio. And over time, our equity curve grows and grows and grows. Yeah, there are some drawdowns, but we are able to get out of that. So there is, no 99% drawdown or anything like that. So we have like normal drawdowns as there are during the investment and trading, and we are able to nicely ride the bubbles. So thank you very much. I hope that you liked today's video. It was about riding the investment bubbles. I hope you learned a lot, and I hope that you join me in the next video. Thank you.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.